Today we are looking at Walgreens, currently trading at $30. Now, Walgreens is currently sitting at that 52-week low. What we're going to take a look at today is their historical prices and data. We're going to jump in and look at the dividend safety and lots of important financial metrics, and we're going to end the episode running it through our stock valuation system model, looking at our four models, getting our intrinsic value, and using our margin of safety, determining our acceptable buy price. Now, one thing to note is that it's down 19% year to date, and if we look at the 10-year graph, Walgreens is down 37%. So you don't have that much stock price appreciation. In fact, it's depreciated if you've been holding this for at least 10 years. Now, the reason why we're taking a look today is that it's at that 52-week low. It also has a yield of 6.4%. Not necessarily things that essentially you'd be looking to just invest purely based on the dividend, but as it's a 52-week low and it's a good dividend yield, let's take a look and see whether or not this is a stock we should be looking at. So looking at the dividend safety, it currently holds a score of 79, which is safe. Its market cap is 25.9 billion, so it's a large cap. And let's take a look at these other stats now. We're going to run through this matrix in further slides, but one thing that I just want to show is that even in the recession 2007 to 9, they were increasing their dividend. Their recession sales were up 5.6% in comparison to the average growth of the recession, and although it had a negative 44%, it did beat the S&P's negative 55%. So if there is a recession happening, or if indeed we are in the beginning of a recession, it could be a stock to consider for your portfolio. Now we're going to run into these other key metrics as we go along. Dividend growth, as you know, if you've been watching my videos, I like to see a minimum of 4%, as that is the inflation rate in the US over the last 30 to 40 years. So if you're not getting at least 4% inflation, well, if you're not getting at least 4% in your dividend growth in your stocks, then essentially you are losing your purchasing power. So the fact the latest increase is 0.5% is very poor. However, when we look at the last 20 years, a 14% dividend CAGR is positive, and for the last 5 years, 5% is. However, this does worry me slightly, this 0.5%, so one thing just to keep an eye on. Another positive thing to notice here is that they have been increasing their dividends over the last 47 years, which means in 3 more years, if they continue to grow that dividend streak, they will be a dividend king. So, moving on, we look at the dividend yield theory. Essentially states that a company is undervalued if its 5-year yield is sitting above the 5-year average. So currently the 5-year average of 3.9%. And the current yield of 6.4% above this means that, according to this theory, the company is undervalued. However, as all my videos do not look at one metric or one theory in isolation, and we want to look at the whole picture and use lots of different theories to come up with our overall conclusion. Another sign of undervaluation here is that PE, the forward PE of 6.5, is well below that 5-year average. And if we look at the sector PE comparison, it's sitting at 6.5, which is below the consumer staples at 21.8. As mentioned, it is also trading at that 52-week low. Now, earnings payout ratio and free cash flow payout ratio, I prefer to look at the free cash flow payout ratio, as the earnings can be susceptible to manipulation through their earnings and their net profits. So for me, I've only kept this here for investors who like to see this. My preference is personally below 60%, as that means that there has room for a company to keep growing their dividends. Now, one thing to note is when we look at the free cash flow, which is what I prefer, it is below that 60% for the large part, excluding 2022 at 76%. So something to keep an eye on. And this forward 12-month estimation is at 71%. Again, something just to keep an eye on moving forwards, and something to consider if you're thinking about adding this to your portfolio. Now, one thing which I do not like to see is right on your screen now. If we look at both the earnings per share and the free cash flow per share, the movement, if we start with the earnings per share, $3.12, 2013, and 2022, $5.04. For me, I would be looking at a lot more growth over the last 10 years, and we can see it has also been, whilst it's increased up to 2018, it has then decreased. So for me, this is a red flag. Again, likewise, on the free cash flow per share in 2013, $3.27 in 2013, and in 2022 it's actually decreased. So again, for me, these are really big red flags. Sales growth for a steady, moderate company like Walgreens, 3 to 7% is preferable, and I would say on the average of things they have been performing quite poorly if we look at total sales. Whilst there have been some years where there has been more than a 3 to 7%, there's also been that negative 9% in 2019, and a few years, as we can see, of 1% and 2% growth, and it's clearly detailed below in the total sales. 2013, 72.2 million sales, and 2022, 133. Whilst that may look good if you were just to look at those numbers in isolation, as you can see for the last 5 to 6 years, it has been essentially flat. So again, for me, another red flag, another worry. Shares outstanding. Obviously, as shareholders, we would like to see the company return excess cash to us by buying back shares. However, we can see here that not only have they been buying back small amounts of shares, they've also, as we can see here, issued shares from 2014 to 2015 and for 2015 to 2016. So for me, overall, I wouldn't say this is a massive red flag, but as a shareholder, it's probably not what I would want to see. Moving on to ROIC, one of my 7 golden dividend metrics, I like to see at least 10%, and whilst they have done that from 2013 to 2019, it has dropped significantly and it continues to be in the low single digits. So again, for me, it's a red flag and probably something to just understand further and just to really understand whether or not you think this business is going to continue to perform poorly over the coming years. Operating margin, free cash flow margin, at least 10% for consumer retailers. They've not really been performing that well, and above 6%, again, they've not been performing as well. Now, while we move on to the last slide, net debt to earnings before interest, tax, depreciation and amortization, we like to see below 3. Again, they haven't been performing as we would like, although it's only slightly higher than the number 3. What this essentially means, in 2022, it would take 3.32 years for the company to pay off all its debt net of cash on hand. Again, net debt to capital around 0.5 for consumer retailers, which is essentially around the target that Walgreens have been performing. So in 2022, 53% of their company's financing was from debt rather than equity. So as we've run through this, I would say mixed feelings, some decent points that we can take out, but also some red flags. It doesn't mean you shouldn't invest in the company. It doesn't mean you should invest in the company. What we're going to find out is whether or not there is some room for the upside and whether or not there's some share price appreciation that we as investors can jump into and work towards. So what we're doing here with Graham's valuation, check out my video going through this if you want to understand how to create your own. We put in the earnings per share, $4.51, and we have a growth rate. The Wall Street analysts targeted around 2%. I've gone for a slightly more conservative estimate at 1.5%, and we also input the current yield on AAA corporate bonds. So this gives an intrinsic value at $36.12. Just to remind you, current share price around $30, so this valuation model is showing 20% upside. Again, we don't look at anything in isolation, we like to look at a few models. So multiples valuation model, here we tend to put in companies of similar size in the similar sector. The only one I could really find and think of was CVS. Now, normally I wouldn't use a model or use this model if there's only one company. However, for this case, I think it's probably okay to use just this CVS. So we input the stock price and the earnings per share, and this gives us the PE multiple. We use the PE multiple, the average PE multiple, which is essentially just CVS, multiplied by the earnings per share to get a multiples valuation model of $39 for Walgreens. We then move on to the dividend discount model, where we input the yearly dividends across the period, and what we're essentially doing here is getting the value of the next year dividend over the cost of equity less the growth rate in perpetuity, with all the numbers that you can see on screen. So the average growth rate over the period has been around 3.77%. Again, I'm being a bit more conservative using 2.5, but also I can see over the last few years it has been quite poor and it has actually decreased. So I think 2.5% from my perspective seems reasonable. This gives a DDM price of $32.80. Now finally, we arrive at the discounted cash flow model. We input the free cash flows over the last 10 years. This gives us the growth year on year, and essentially we have the average growth rate at 6.4%. Now I've gone with a forward looking of 4%, again much lower than the average growth rate and much lower than the Wall Street estimates, just because I want to be quite conservative. And in terms of what we've just run through, there hasn't been many positive points for me to say that Walgreens will be able to keep up with the average growth rate. Again, different people will have different perspectives. I've gone for a more conservative outlook. This gives us our future free cash flows. From this, we then use our discount rate to arrive at the present value of our future free cash flows. We then add the cash and cash equivalents, subtract the total debt, and arrive at the equity value. We then divide by the current shares outstanding to get a DCF price of $34.38. So we've just run through those four models, which has given us these prices. We then get to our intrinsic value, which is the average of these four. Again, as always, smash the like button, smash the subscribe button if you are enjoying the content, as it means a lot. Do let me know your thoughts in the comments and other stocks you want to be reviewed. So this gives us an intrinsic value of $35.60. Now the current share price is $30, and we always have a margin of safety. Normally for companies, I like to look at 10%, and I can tell you for the Walgreens, I will be using a much higher rate. But if you were to have a 10% margin of safety, that would be $32 would be your buy. If you were looking at 20%, that would be around $28.48. If we just take a quick look, we can see that is right around the 52-week low. However, for me to really go into a company like Walgreens, I would need to see more than 20% at around 25%, just from what we've been looking at. So around $26.70 would be my buy, and it's on the watch list at $27. Now, before we finish, we're going to look at the Wall Street price forecast. They've targeted a price of $39.91. So they see around 30% upside to the current share price over the next 12 months. Before you go, smash the like button, smash the subscribe button. Let me know your thoughts about Walgreens in the comments, and let me know any other stocks you'd like to see reviewed. Thank you, and as always, have a lovely day.